Welcome back to another episode of Palisade Radio. This is your host, Collin Kettell. Today we have on James West, the publisher of the Midas Letter and the Midas Letter Financial Radio podcast. James has been at the radio gig for a lot longer than I have and is naturally gifted with a radio voice, so I will do my very best to keep up. James, welcome to the show.
You are too kind. Thank you, Collin.
The Midas Letter's been around since, well, I don't know, it's been around for a long time. When did you first start the Midas Letter, and how many subscribers do you currently have?
I wrote the first Midas Letter edition, was published in March 2008. Letter has gone as having 14,000 subscribers and as low as 400 subscribers. Those are all free subscribers. In terms of paying subscribers, I've had as many as 1,700, and currently I've just reopened the payment gateway because we closed it and refunded money to our subscribers when the mining markets turned horribly south. So right now we've got about 8,500 free subscribers and just about 200 paying subscribers.
Well, I have to applaud your ethics for returning money in a bad market when I'm sure any paying newsletter writer could use the funds or would like to have the funds. So your subscriber base must be very dedicated at this point. What's your methodology on writing, on putting together the newsletter?
Well, my whole approach is to be first and to be out first too, if necessary. So we look to identify emerging situations that are not yet public or have just become public, and get our subscribers and ourselves into the earlier financings so that the return on investment happens sooner and happens more substantially than it would if they just bought it out of the market.
Right, and we actually hung out quite a bit at the PDAC in March, and we were at your informal office, as you called it, at the Azure restaurant, which is of course at the front of PDAC. There were a plethora of people that came by, and everybody knows who you are. You've been around for a long time. I'm sure that allows you to get access to great deal flow for your subscriber base and for people that you work with. Are you looking at buying stuff on the open market, or do you also participate in private placements?
Generally, we strictly participate in private placements. Very seldom do I play in the market. I'm a horrible trader, but I'm a great shopper. So from my perch here on the 28th floor of Bay and Queen Street in downtown Toronto, every deal worth its merit in Canada ends up banging on my door. So I get to see absolutely everything.
What are the successful examples of picks that you've made in the last few years? I know that the mining sector has been a tough one since 2011 to make a good pick in. Anything outside of the mining sector? And what about deals in the mining sector?
So in 2014, after the PDAC, I committed in my mind that I was going to pull the Midas Letter back from mining coverage and focus more on emerging technology coverage, life sciences, even a little bit of medical marijuana, which at the time was just getting started. However, I did meet Paul Hewitt from Klondike Mines in February 2014, just before PDAC, and he had just acquired the Midas mine and told me that they could make money with that mine at $700 gold. And so that was my last mining recommendation of 2014 before I made that switch. Fortunately for us, we made it at $1.68, and it trades somewhere between $2.40 and $2.60. I don't know where it's at today. So that worked out well for us. But the other big pick of 2014 for me was patient home monitoring, which we published a recommendation in the June 2014. The stock was trading at 33 cents. Of course, it's trading above $1.60 now. That's a $300 win. So those are some of the biggest ones, but there are others like Poet Technologies. PTK on the TSX Venture was a good one. There's, let's see, People Corporation we picked at 280 and it's now 330. So that's the essence of the strategy, is to find these companies when they're just about to have a value appreciation event. And then I always tell my subscribers that they should sell half their stock when it doubles and ride the rest until it really starts to lose steam or gets taken out. So that's been the strategy for 2014, 2015.
You clearly had some strong foresight to get out of the mining sector. Even though it maybe had already started to fall, it certainly continued that fall. But it seems now that we're starting to come into maybe a bottoming formation. There's some talk that gold's going to go to 900, and other people are mentioning that gold might be ready to move back up above 1400. What do you see happening from the perspective of looking at deals and what's getting financed? Are you seeing any excitement starting to raise back up in the mining sector?
No, quite the contrary. I would say that in the mining space in general, at least in the Toronto investment banking community, there's a marked lack of enthusiasm. In fact, a lot of guys complain they can't even get a meeting. In terms of the gold space, there's absolutely nothing going on. Nobody even wants to hear a gold story at this point, except for, of course, the diehard gold bugs who will always listen to the story. But no, it doesn't seem to me like there is any sort of reason for optimism even going forward, at least for mining and for now oil and gas as well.
So when you look at the dynamics of the global economy, take the US economy, for example, and the general equities are moving up right now, that bodes well for some of the technology and biotech plays that you've been covering. But at the same time, there's a little bit of concern starting to grow as low interest rates continue and rampant money printing seems to be never ending. What do you expect to play out 2015, 2016 moving forward?
Well, you know, that's really hard to say, Colin. The arbitrary nature of central bank policy makes it very difficult, if not utterly impossible, to evaluate fundamentals on the macroeconomic stage at this point in our history. So, by way of example, you know, we're being led to raise our expectations for an increase in interest rates in Q1 of this year, but then we get some bad numbers out at the beginning of Q2, and suddenly the language coming out of the Fed becomes more dovish, and our expectations are now tempered so that it won't happen as quickly as we can. So, I mean, really, we're dealing with a situation where the banking policy, the interest rate policy set by the most powerful institution in the world in that field, the U.S. Federal Reserve, is humming and hawing and sitting on the fence and jumping off the fence and sending mixed signals. And, you know, it just, to me, it's impossible to predict. We know they have to raise rates because it's just an unsustainable situation with low interest rates. At the same time, if they raise them too fast and too high, that has horrible repercussions for banking in other economies around the world. So it could easily catalyze a broader economic contraction, which is something that they don't want to do. You know, from Ben Bernanke's earliest days, he made it clear that the Fed was targeting stock market numbers as a barometer for the health of the U.S. economy. And in fact, you know, the original TARP plan was specifically rolled out with an eye towards, you know, achieving healthy market index valuations. So knowing that that mentality is present, at least in some degree, still within central banking policy, to me, renders the entire global economic proposition unascertainable, at least on fundamental grounds. So how does it all end? Where does it end? I mean, it's got to end with higher rates. It's got to end with capital contraction. You know, Europe's still busily printing 50 billion euros per month right now. Japan, China, both quantitative easing in large measure. The U.S. is reinvesting the proceeds from its quantitative easing programs. So on a net-net basis, there is very much a global liquidity production cycle still underway. And I would argue that it was an excess of liquidity, and it is an excess of liquidity in credit that catalyzes bubbles and economic contractions, which you know, 2008 was a perfect example of a severe economic contraction. So it doesn't end well. To use an Australian term, I think it all ends in tears for somebody. But at the same time, volatility is where money is made. You align your interests with the right parties, and you should do very well.
It seems like today the United States leads the charge around the world for the mandate, for the money printing, the low interest rates, but there's a lot of stuff going on below the surface. For example, the AIIB Bank, or the Asian International Infrastructure Bank, just had its application window closed, and on the second to last day, Israel, of course a strong ally of the US, or was a strong ally of the US, joined in with Britain, Australia, and several other countries to join an infrastructure bank that is potentially going to go against the United States-led World Bank and IMF. What I'm trying to get at is, as things unravel here, do you see that the United States is going to lose its grip as controlling the global economy?
Oh, well, that's a loaded question, but obviously it is within every country's interest to have the strongest superpower in the world brought to heel in some measure. In other words, we don't want an all-powerful U.S. We've already seen what that does. It gives them the strongest dollar. They've got the global currency unit of trade. It's it's omnipotent, the strongest military. Basically, what the U.S. says is what goes in global foreign policy and economic policy. So there's naturally a kickback to that, and in fact, there's sort of a reorientation going on that was probably never that far under the surface, but certainly for the period through the 90s and the early 2000s, it appeared that the East-West axis was becoming sort of subordinate to global economic cooperation and interest. Now that seems to be reemerging, especially in the case where China is building in partnership with Russia the pipeline from Russia that will supply a substantial portion of its annual natural gas requirements, which puts China on a better footing when it's negotiating the price of LNG imports into China from the United States and from Israel, from elsewhere. So, China is the second most strongest superpower, arguably, both militarily and economically. I mean, even though at this point Japan is still somewhat substantial, but all eyes are on the axis between the U.S. and China. So in Canada, we really don't have the ability to anger our neighbor and sign up for the Asian alternative to the International Monetary Fund. But the other countries that are in the eastern hemisphere of the planet have an incentive to do so, in that, they're as close to China as they are to the U.S., and it serves their interests to diminish the power of the biggest superpower, even if it means increasing the influence of the second largest power. So, that's a situation that's really born of ancient history. One could argue that the U.S. is seeking to undermine China's power by selling it all of its overrated paper, and China is buying all of its overrated paper while it accumulates gold in preparation for a date where they pull the rug out from underneath the U.S. dollar. And that's a story that's kind of always the subtext to the whole global picture going forward.
Well, James, that was a very articulate answer for such a loaded question. How can listeners go ahead and get this type of detail from you? Are you back to having a subscription service after you refunded all of your subscribers back a couple years ago?
Yeah, we just opened it up. It's $49 a month, $4.99 for a year. It's free to try. It's an unconditional 60-day money-back guarantee for the first 60 days. And basically the way to do that is go to midasletter.com/subscribe.
All right, there you go. Thanks so much, James. I appreciate getting you on the show, and I'll be sure to get you back here soon.
Thank you very much, Collin.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, troll, did you hear what's going on in Yemen, or are you too stupid?